Australia is one step closer to economic Armageddon. Martin North, John Adams, in the interest of the people. Well, John, a turning point.
It appears to be a psychological turning point, Martin. So last night we saw for the first time in this economic cycle since the global financial crisis, the inversion of the 2 and 10-year yield curve on the US bond market. So what does that mean? It means that the interest rates on 2-year US government bonds went slightly higher than 10-year US government bonds. And obviously that saw a significant reaction in the markets. So we saw the Dow Jones Industrial Average fall more than 3%, 800 points, the largest fall in 2019. It sort of triggered, news alerts from CNBC and some of the other financial channels. Our local media has reported it this morning. This morning I was on ABC radio on the Sunshine Coast because they reached out to me to say why is this significant, why is this getting some buzz, and obviously we also saw gold and silver prices go up in response as people seek some safety from the turbulence that the markets experienced.
Yeah, it's interesting because the 210 is not actually seen necessarily as the most significant one, right? There was the 110 which actually went inverted earlier, right? And the other thing that's interesting to note that it came back later. So it's like it blipped and then came back, and yet the media have really hyped it up this time.
Yes. So there's a couple of points to make. So statistically, what we covered in March in our previous post when we said that, the economy is likely to implode within 27 months. So the U.S. Federal Reserve, the central bank itself said statistically, going back to 1969, the most accurate predictor of a U.S. recession is the inversion of the 1 to 10-year yield curve that happened in late March of 2019, so earlier this year. Now, the 2 to 10 had not inverted, and so I think some firms and analysts on Wall Street were hedging their bets as to whether a recession was coming or not. But obviously, the 2 to 10 has now inverted, so basically there is no excuse now. All of the key predictors of a recession are coming, and so obviously for those who are denying we're headed into a more difficult economic time can no longer say that.
Yeah, and it's interesting that a lot of the reporting was talking about the global downturn. It was talking about China. It was talking about the trade wars. It was talking about Brexit, Europe, Hong Kong, right? So it's the confluence of a whole bunch of issues as well as the specific issues within the US. And of course, we look at the US because it's such a significant portion of the total economy. And frankly, if the US goes off, then Australia's going to go very off, isn't it?
Exactly. So obviously the US economy is the largest economy still in the world. It has the largest financial markets. So obviously if the US economy goes into some sort of recession, that's going to have huge ripple effects right across the economy, right across the global economy. And obviously parts of Europe are either sort of in recession or close to recession. And then obviously we're starting to see some financial problems in China and also in parts of Southeast Asia. So obviously, the epicenter of the last global financial crisis was the US. And obviously if the US has a major economic hiccup, that's going to ripple right throughout the world. So just to go back, so when we covered the inversion of the 1 to 10-year yield curve, I showed some analysis that I had previously done, and based off the last 7 recessions, going back to 1969, the recession is likely. We said at that point the recession was likely to happen anywhere between within 27 months because that was the previous experience. So from March of 2019, 27 months takes us to June 2021. So we now have another signals indicating that a recession is coming. And obviously, the reason why this is significant is that, as I continue to say, Australia has the biggest debt bubble statistically since the arrival of the first fleet. At the same time, we've got the biggest debt bubble in the history of the world. So we're at least $90 trillion more in debt compared to 2007. And so as we go into recession, if governments, firms, or households, have less income to service their debts, you're going to start to see problems with debt defaults. And obviously, because there's so much more debt, and more firms and more individuals are in debt, and governments are more in debt than 11 years ago or 12 years ago, what that means is that it's a more likely situation that we're going to have a more systemic crisis. And a systemic crisis means that if a critical number of economic agents can't pay their debts, it leads to a economy-wide problem or crisis, and that is what economic Armageddon is. Now, last year for News.com, I wrote a 4-part series about economic Armageddon, and one of the articles I wrote was this 6 pathways to Australia's economic Armageddon, where I outlined my 6 scenarios, which are slightly different to your DFA models. But basically, what I said at that point is we've got 6 scenarios, and it comes down to a simple proposition. We've got this big bubble, debt bubble, and the first 3 scenarios is if the debt bubble pops. So as we go into this recession, if they can't rescue the debt bubble and the debt bubble pops, we're likely to see a significant deflationary event where people effectively, or households, corporations, or governments default on the debt, and that could lead to a depression, sovereign debt crisis, or a local currency crisis, i.e. a country defaulting on its foreign debt. And this is where Dr. Peter Brain and Dr. Ian Manning in their book Credit Code Red talk about that's a risk for Australia. So that's the scenarios 1 to 3. Scenarios 4 to 6 is that obviously world central banks, including our own governor, has said that they are willing to launch, quote, unconventional policy. So what does that mean? It means massive amounts of money printing, quantitative easing, helicopter money, MMT, deep negative interest rates, and obviously massive fiscal spending as well. And all of these policy measures are to rescue the debt bubble and to avoid some sort of global recession, depression. So now. And obviously what I've tried to say in the debate against Christopher Joy, but also here on this show, is to say that there is a consequence to unconventional policy. So it's not costless. So the consequences are likely to be problems with the value of currencies, runaway inflation, and obviously an exacerbation of too much debt in the system. And so this is where these scenarios of 4 to 6 come in, from runaway inflation, potential hyperinflation in some countries, stagflation, or even a global currency crisis. So these are one of these 6 scenarios I still hold it will eventuate from the situation that we're in. But obviously, even though that last night wasn't statistically significant, it was definitely psychologically significant. And obviously, I think you'll see a downturn across the world in terms of economic confidence, market confidence. And then obviously, if people are less confident, if firms are less confident, it means that firms will be less willing to invest, less willing to hire. They'll cut back on a whole host of corporate decisions, but also households will be less willing to spend, more willing to save, obviously less willing to borrow, and that will obviously perpetuate a global downturn. And then obviously the debt, both in Australia and around the world, the serviceability of that will come into question. And obviously, I think a central thesis of what you and I have been trying to communicate to the audience is that even though the establishment says that the debt is serviceable, we hold the view that it's not serviceable, both in this country and around the world.
Yeah, I think that's right. And, let's sort of separate, if you like, the facts from the hype around the facts, but also the psychology, right? Because actually, ultimately, it comes back to the psychology of markets and the psychology of people and firms. Right? And what's different this time is that this particular event that happened overnight has spooked a lot of people, have basically created a whole bunch of momentum in terms of the thinking around what's going on. Maybe as a result of that, the markets will react and overreact. But nevertheless, the indicators are still very clear, and nothing has really substantially changed the direction of travel. We're heading towards a crisis. The reason we're heading towards a crisis, too much debt.
Martin, so I think what you said has a lot of value. Last night has more psychological impact than it is statistically significant. Look, we're going to start to see more bad news coming forward, and the bad news will reinforce bad news, and that obviously will push the global economy faster into a global economic recession sooner rather than later.
Yeah, so John, I'm conscious that there was a debate between you and Christopher Joy a few weeks back, right, which actually got a lot of views on YouTube. And one of the things that Chris Joy said was that if there is a global recession, all bets are off with regard to house prices.
Indeed. So, I mean, here was this big debate that Christopher and I had earlier this year. I was arguing that we're headed towards a systemic crisis. Christopher said that I was a commentator in search of a headline. But then at the 23-minute, 13-second mark, Peter Switzer asked the question, quote, is John going to be more right if we go into a serious recession? And then Christopher said, 100%, all bets are off. If we go into a global recession, we are going to have a big problem. So here's my nemesis saying that we will have a big problem if we go into a global recession. Obviously, this new signal in the US bond market is an indication we're headed towards a global recession. Labor spoke about this before the election when Bill Shorten and Chris Bong talked about a global shock. Well, the global shock seems to be coming. And so, even on this cash transaction ban bill that we've been discussing in the last couple of weeks, I have had face-to-face meetings with Liberal MPs and senators, Labor MPs. They know that we have a big bubble. They know that the Morrison government has been to date exacerbating the bubble, and politicians told me to my face that we know what's going on. We know what we're doing. We know it's not unsustainable. And obviously, we are now headed towards a global shock. And again, we are in the most vulnerable position to handle a global crisis because we have the biggest debt bubble in history, and too many households do not, have basically terrible balance sheets, too much debt, not enough buffer, and we have too many workers employed in these very highly concentrated industries that are focused around the bubble, and they are very vulnerable to losing their jobs if there is a significant domestic or global downturn.
So buckle up, John. It's going to be an interesting ride the next few months.
Indeed.
Martin North, John Adams, in the interest of people. We'll see you next time.